Let's talk about the speed with which we are watching this market deteriorate.
Dow at the same time has fallen about 18%.
The stock market is now down 21%.
If history has shown us anything, it's that unpredictability, crashes, and remedies are typical pieces of the effective financial planning cycle and the cost of admission to what's seemingly the best wealth creator on earth. In 2022, we might well observe a stock market crash, and one or more of the following 6 factors could be the catalyst that causes it, according to Chamath Palihapitiya. So let's begin. Who is Chamath Palihapitiya? Chamath Palihapitiya is a Sri Lankan-born Canadian and American financial capitalist, engineer, SPAC support, pioneer, and CEO of Social Capital. Palihapitiya was an early senior chief at Facebook, working at the organization from 2007 to 2011. Following his takeoff from Facebook, Palihapitiya began his fund, the Social Plus Capital Partnership, through which he put resources into a few organizations, including Yammer and Slack. The Social Plus Capital Partnership changed its name to Social Capital in 2015. He is a co-host of the innovative digital broadcast All In. With expected total assets of around $1.2 billion as of April 2021, Palihapitiya was positioned at 2,378th on the Forbes rundown of billionaires in 2021. So here are the possible reasons according to Chamath. 1. New variants of COVID-19. Apparently, the most ridiculously glaring worry for Wall Street keeps on being COVID and its variations. The eccentrics of the spread and harmfulness of new COVID-19 strains imply a getting back to the ordinary is still possibly far off. With each nation apparently having its own way to deal with handling the pandemic, production network issues and work process interruptions could stay throughout the year. 2. Crypto crash. Sadly, the crypto market has not been able to decouple from the stock market and characterize its own personality. Likewise, a good level of crypto financial backers are additionally giving a portion of their cash to do something in stocks. A crypto crash in 2022 would probably burden stocks reliant upon the cryptocurrency environment, as well as decrease investment capital for equities. 3. A hawkish Fed. This is the third possible reason. For a significant part of the past 13 years, the country's national bank has advanced a hesitant money-related strategy. At the end of the day, it continued to loan rates at or close to noteworthy lows and embraced various quantitative easing (QE) drives that intended to float trust in the real estate market and overload long-haul treasury bond yields. Starting in 2022, the Fed will unwind its QE program and will probably raise rates by 25 basis points on several events. As admittance to super modest capital becomes more difficult to find, the assumption is that by and large financial development will slow. This is concerning on the grounds that development stocks have fueled the S&P 500 higher starting around 2009. 4. Margin-induced implosion. Another major reason, as per Chamath, is the rising margin debt. That is, how much cash is being acquired from businesses and establishments with premium to purchase or short sell protections. After some time, seeing the increase in margin debt outstanding will be normal. However, a fast expansion and extraordinary edge obligation is in many cases terrible news. As of November 2021, almost $919 billion in edge obligation was exceptional. That is almost twofold how much edge obligation during the pandemic low a long time back. 5. The focus on value. Valuation is one more clear worry for the stock market in 2022. Entering the year, the S&P 500's Shiller cost-to-income (PE) proportion was at 40, which addresses a 2-decade high. The Shiller PE inspects expansion and changed income throughout the course of recent years. This is above and beyond twofold the normal Shiller PE for the S&P 500 of 16.9, going back over 150 years. 6. China's tech crackdown can extend for more years. For the past 2 years, China has been a headwind for Wall Street. The second biggest economy on the planet by GDP went into a trade battle with the US a long time back. In the interim, concerns were raised last year when controllers started getting serious about the country's greatest tech stocks. While it's hard to express out loud whatever 2022 will have coming up for the world's number 2 economy, there's been no sign of controllers relaxing their hang on China's driving trailblazers. The shortcoming in key China stocks, as well as possible adverse consequences on advancement in supply chains, threatened the US equities. Last but not least, history repeating itself could be the catalyst that leads to a stock market crash. Chamath points out that we're currently 22 months eliminated from the pandemic bear market base. and still can't seem to see a two-digit rate pullback in the S&P 500. History would recommend it's coming and in the near future. We hope you liked the content of this video and got to learn something new. Thanks and goodbye.